Corpay, the business payments company, formerly FleetCor Technologies, rebranded in 2024, operating the dominant fleet fuel card network, corporate lodging payments, and cross-border B2B payment infrastructure.
FY 2025 revenue $4.5 billion. Q1 2026 revenue $1.26 billion, up 25%. Cash EPS 580 beat the 550 estimate. FY 2026 full-year cash EPS guided 2670.
FleetCor was founded in 2000 to provide closed-loop fuel cards for commercial fleets, allowing companies to track, control, and reconcile fuel spending across thousands of vehicles.
Through over 60 acquisitions, CEO Ron Clark expanded into corporate lodging, tolls, healthcare payments, and cross-border B2B transactions, building a diversified payments platform across 15 countries.
In 2024, FleetCor rebranded as Corpay, signaling the shift from a fleet-focused niche to a broader corporate payments identity, serving enterprise treasury and procurement functions.
Vehicle payments generates approximately 50% of revenue. Fleet fuel cards, commercial tolls, and corporate mobility solutions used by over 1 million commercial vehicles.
Corporate payments contributes 30% through virtual cards, cross-border B2B transactions, and accounts payable automation, the fastest-growing segment at over 20% annually.
FY 2025 revenue $4.5 billion at 44% adjusted EBITDA margin, among the highest margins in financial technology. Free cash flow conversion above 80%.
Q1 2026 revenue $1.26 billion, up 25%. Cash EPS 580 beat the 550 estimate. FY 2026 cash EPS guidance raised to 2670, accelerating earnings growth.
WEX Inc. is the primary pure-play fleet card competitor, smaller scale, less diversified, and lacks Corpay's cross-border corporate payment capabilities.
MasterCard and Visa compete in corporate cards broadly. Nuvei, Payoneer, and Flywire compete in cross-border B2B. No competitor matches Corpay's combination of fleet card scale and corporate payment breadth.
Corpay's moat is the closed-loop data network. Fleet cards generate spending controls, analytics, and fraud prevention that open-loop credit cards cannot replicate for commercial fleets.
Corpay operates across North America, Europe, Australia, New Zealand, and Latin America, with the U.S. and Brazil as the two largest markets by revenue.
The cross-border corporate payments segment processes transactions in over 140 currencies, connecting U.S. companies paying foreign suppliers through Corpay's currency conversion and payment rails.
Ron Clark has served as CEO of Corpay since 2000, one of the longest-tenured CEOs in financial technology, growing the company from a startup to a $12 billion market cap.
Clark holds degrees from Union College and Harvard Business School. He joined FleetCor as founder CEO and led over 60 acquisitions, building the payments platform now operating as Corpay.
Corpay, the business payments company, $4.5 billion in FY 2025 revenue, operating the dominant fleet fuel card network and fast-growing corporate payment platform across 15 countries with 44% EBITDA margins.
Q1 2026 revenue $1.26 billion, up 25%. Cash EPS 580 beat the 550 estimate. FY 2026 cash EPS guided 2670, Corpay's earnings acceleration continuing into 2026.
25%.
Corpay was founded in 2000 as FleetCor Technologies in Atlanta. It built its initial business providing fleet fuel cards to commercial vehicle operators, think trucking companies, construction fleets, field service businesses, allowing them to manage and control employee fuel spending. Over 2 decades, it expanded through acquisitions into corporate lodging cards, cross-border business payments, and vehicle payments. In 2024, it rebranded as Corpay to reflect the broader corporate payments identity.
The business model is payment facilitation with embedded analytics. Corpay earns interchange fees on every transaction processed through its payment cards, spreads on foreign exchange conversions, and subscription fees for software platforms that help corporate customers manage and report on spending. The key economic insight is that corporate payments are more sticky than consumer payments. Once a company integrates its accounting software, ERP system, and expense management with Corpay, switching is operationally complex and expensive.
Revenue for Q1 2026 came in at $1,260,987,000, up 25.4% year over year. Analysts were expecting approximately $1,095,000,000, a 15+% beat on the top line. Cross-border payment volume drove the outperformance, with corporate treasury clients expanding their FX hedging and international payment volumes in an environment of elevated currency volatility.
Earnings per share of $5.80 beat the consensus estimate of $5.50, a 5.5% positive surprise. The gross margin data shows a compressed reported gross margin due to the revenue recognition treatment of cross-border payment volume. When FX spread revenue is the primary driver, gross margin percentages look lower even when the dollar profitability is excellent. Adjusted operating margins are healthy and expanding.
Cross-border is the growth engine. Corpay has built a treasury and cross-border payment platform serving middle market and enterprise companies that make international payments in dozens of currencies. The target customers are companies that are too sophisticated to use their bank's standard wire transfer service but not large enough to run an in-house treasury operation. Corpay provides the FX expertise, hedging tools, and payment execution at competitive spreads, essentially treasury as a service for mid-market multinationals.
The lodging card business is Corpay's most differentiated product. It serves the workforce lodging market, companies that house temporary workers, including construction crews, oil field workers, and disaster response teams, providing managed payment programs for hotels and extended stay properties. This is a vertical that banks and general-purpose corporate card companies largely ignore because the customer base is fragmented and requires specialized operational support. Corpay's incumbency in this niche creates significant switching costs.
CEO Ron Clark has led Corpay since its founding in 2000. He is a serial acquirer. The company has completed over 60 acquisitions since 2006, with a disciplined approach to purchase multiples and integration. Clark was the architect of the strategic pivot from fleet cards to corporate payment platform, and the Q1 results validate that the pivot is generating revenue growth well above what the fleet business alone could deliver. He has guided the company to consistent earnings per share growth for over a decade.
Ron Clark's acquisition playbook is notable. He targets companies with proprietary payment networks, embedded customer relationships, and recurring revenue, businesses that have moats similar to Corpay's own. The integration model emphasizes preserving local management, cross-selling Corpay's international capabilities into acquired customer bases, and gradually migrating acquired platforms onto shared technology infrastructure to realize cost synergies over time. Analysts credit the model with generating consistent returns above cost of capital.
The bull case is the cross-border payment opportunity. Global B2B cross-border payments are estimated at over $20 trillion annually, and the vast majority are still processed through banks at opaque spreads and high fees. Corpay's transparent, technology-driven platform has a cost and transparency advantage over bank FX desks. As treasury functions at mid-market companies professionalize and seek alternatives to their relationship banks, Corpay's addressable market expansion is substantial.
International expansion is the accelerant. Corpay has built operations in Europe, Latin America, and Asia Pacific through acquisitions, and each regional presence is a cross-sell opportunity for the company's full suite of corporate payment products. A fleet card customer in Brazil can become a cross-border treasury customer. A lodging card customer in the UK can adopt vehicle payments. The platform economics improve as the revenue mix per customer broadens.
The bear case is macroeconomic sensitivity. Commercial fuel spending, still a significant portion of total transaction volume, tracks economic activity closely. Trucking miles driven, construction activity, and field service deployment all fall in recessions, reducing fuel card transaction volumes. In a meaningful economic slowdown, Corpay's fleet segment would be under pressure even as the cross-border business shows more resilience. The mix shift toward cross-border is diluting this cyclical risk but not eliminating it.
Fintech competition is the structural risk. New corporate payment startups, Airbase, Brex, Ramp, are competing for the corporate expense management market with modern software interfaces and attractive card economics. While Corpay's specialized verticals in fleet, lodging, and cross-border are not directly attacked by these generalist platforms, the overall market for corporate payments is becoming more competitive, and any player that develops specialized fleet or FX products could erode Corpay's incumbent positioning.
On the balance sheet, Corpay carries moderate leverage, typical for an acquisitive company in a capital-light payments business. Free cash flow generation is strong, and the company uses that cash to fund acquisitions and return capital through share buybacks. The debt load is manageable, given Corpay's consistent free cash flow and the resilience of its recurring payment revenue streams. Management has guided toward maintaining leverage within a target range as the acquisition strategy continues.
The bottom line, Corpay delivered an exceptional Q1 2026 with 25% revenue growth and a clean EPS beat. The cross-border expansion is ahead of schedule, the lodging and vehicle payment verticals are performing, and management has a credible, long-term growth algorithm. For investors seeking a high-quality B2B payments compounder with a large international expansion opportunity and a CEO who's been executing for over 2 decades, Corpay is worth serious attention. Corpay's business is built on payment network effects that are difficult to replicate. In corporate fuel cards, Corpay's acceptance network covers over 800,000 fuel locations globally. A fleet operator who issues Corpay fuel cards to their drivers can authorize those cards at virtually any fuel station in North America or Europe. The value is not the card itself. Any bank can issue a card. It is the acceptance network and the data it captures. Corpay knows the fuel grade, the odometer reading, the driver ID, and the time of purchase for every transaction. That data enables cost controls that eliminate fuel fraud, which costs U.S. fleets an estimated $3 billion annually.
The corporate payments segment, lodging cards, AP automation, virtual cards, is where Corpay is growing fastest and where the multiple is being earned. Corporate payments revenue grew at approximately 30% year-over-year in Q1, driven by virtual card adoption in accounts payable workflows. Large corporations use Corpay's virtual card platform to pay suppliers on extended terms while giving suppliers immediate access to funds, a working capital optimization that benefits both buyer and supplier. Corpay earns interchange on every virtual card transaction, creating a payments revenue stream that scales with transaction volume and is highly recurring.
International growth is the longest duration opportunity in Corpay's story. The company has made over a dozen international acquisitions over the past decade, building fuel card and corporate payments infrastructure in Brazil, the UK, Germany, Russia, and Southeast Asia. International revenue now represents over 40% of Corpay's total, and management has signaled ongoing M&A appetite for geographic expansion. The fragmentation of corporate payments outside North America creates acquisition opportunities at reasonable valuations, and Corpay's integration track record has been stronger than most payment processors of comparable size.
The valuation dynamic for Corpay is interesting. The company trades at approximately 17 times forward earnings, a discount to pure-play fintech peers despite higher revenue visibility from its contracted fleet and corporate customer base. The discount persists partly because the fuel card business sounds pedestrian, and partly because Corpay's revenue mix between legacy fleet and high-growth corporate payments makes it harder to model than simpler peers. As the corporate payments segment grows toward 50% of revenue, Corpay's revenue quality improves, and the multiple discount should narrow. The Q1 EPS beat of 25 cents demonstrates that the model is executing. This is financial education only, not personalized investment advice. B2B payments involve macroeconomic, competitive, and foreign exchange risks that require individual analysis. Consult a licensed financial professional and review Corpay's SEC filings before making any investment decision. Thank you for watching Charged Alpha.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall